So you just got pre-approved for a home loan and you've gone out shopping, looking for houses, and you think you found the right one. Well, these mistakes could cost you that house even after your offer has been accepted. So don't make these mistakes. And I'm going to get to those right now. Hey everybody, I'm Jerry Norman with Oregon Life Homes. I've been helping first-time home buyers buy here in the Roseburg area for the last few years. I absolutely love it. There's nothing better than handing you over the set of keys to your first home. But these crucial mistakes can cost you that dream home. And we are going to get into it right now. All right, so I'm going to tell you about a story that happened to one of my clients not too long ago. Let's call him John. Got a pre-approval. And so we started shopping for homes. Well, we found the home that was going to work perfect for him. It was in the perfect location. And so we made an offer and we got it accepted. So John went out and paid for the home inspection and it came back pretty good. So everything's going through and now we had the appraisal set. Now, as time goes on, we are about a week, just over a week to closing. Everything is looking good. Everything looks like it's going to go through. Well, John and his wife thought it would be a good idea to go out and start looking for furniture to furnish the home, lawnmower, all the stuff they needed to be able to live in the home. So they opened up a credit card. No big deal, right? Wrong. That small decision created a domino effect. His debt to income ratio tipped right over the scale, which made it to where his lender couldn't lend him funds to close the house. So 1 week before closing, he got the call. The financing was denied. No house, got to return all that furniture if possible. It was on order. Hopefully he was able to return it. So here's the thing. You can kill your dream of home ownership even after your pre-approval all the way up until day of closing. And here are going to be some steps to avoid if you are looking to buy your first home and things to avoid once you're under contract to buy that first home. So first off, what is the pre-approval? The pre-approval is basically the lender pre-approving you for a home loan based on your current financial situation. At the time you apply, the lender is granting you the pre-approval and believes that you are a good candidate for the loan. It's like being invited to apply for a job, but not having the job yet. Think about it. Would you start celebrating a new job after you nailed the first interview? Or would you wait until you actually had the offer signed in hand? A pre-approval is based on a snapshot in time, your income, your credit score, and your debt as of the day they pulled your credit. And if anything changes, you better believe that the lender is going to find out about it because they do their final checks just days before closing. And that's why it is crucial to keep your financial picture stable between the time you get the pre-approval and the time you close on your house. Here's another way. What if you get a new job offer in the same company? You might think, hey, it's a better job, better pay. This got to be good, right? Changing jobs after your offer is accepted could be a huge red flag for lenders. Lenders could view a career change as a risk because they can't predict that you're going to be stable in that new role. Once I was working with a buyer who got an amazing job at a different company. Better pay, better benefits. He took the position without telling the lender. Guess what happened? Days before closing, they went to verify his employment and underwriting froze the file. They needed 2 pay stubs with the current job, and it just so happened that it was in the same field, so it wasn't too bad, but it delayed closing, and the seller didn't want to extend anymore. They put the house back on the market, so the deal fell through because the lender needed more time to verify employment. And we were just 7 days from closing. That whole deal just fell apart because of that one decision. So if you are thinking about changing jobs, don't do it until you actually have the keys to the new home in your hand. The next one. So you're under contract and you're out on a Saturday afternoon and you're driving by a furniture store. Hey, let's stop in. So you stop in and you find some furniture that you absolutely love. So you open up an in-store credit with them and you have delivery set for the day of closing and everything's going well. Well, guess what? When you open a new line of credit, your credit report takes a hit immediately. New credit accounts will lower your average account age and increase your debt to income ratio. And those are the two things that underwriters laser focus in, especially right before closing. So, is that shiny new couch worth losing the cost of the roof over your head? Remember, lenders pull your credit right before closing. If they see a new furniture card or any new account, you could instantly become a higher risk borrower, resulting in a loan denial, home lost, and the heart shattered. Here's a tip. If you absolutely need to make a big purchase, wait until the keys are in your hand. A lot of people, especially here in the Roseburg area, rely on overtime as part of their income, which is fine because the lender usually will average over the course of time all of your overtime. But here's what could be a little risky. If your hours suddenly get cut right before closing, that could cost you your home. One buyer that I was working with worked a ton of overtime for the last 2 years. And then once he got it pre-approved, changed jobs, and now there's no longer any overtime. So the lender, 3 days before closing, could not close on the loan because he was no longer in that position and did not have the overtime. He was getting the same base rate, but not the overtime. So it limited out his debt to income ratio, and he was way over the mark, which we had to cancel the transaction because the financing fell through. Not the lender's fault, but if you are going to take a new job, talk to your lender first, but it's always, always best to wait until after closing, once you have those keys in your hand. If you are depending on overtime for your salary, make sure it is rock solid. Another way, and things to really watch out for, you're in the company and you get a promotion or a position change. It is always best to talk to the lender just to make sure that that will be okay. Because really, even if you are making $2 more an hour or whatever, the waiting just until you close should be much more beneficial. Imagine this, you're just 2 weeks away from closing and you accept a new position that changes your whole pay structure. Say it's commission based or whatever, but you know when you take the position that you're going to be making more money. The one who doesn't is the lender or the underwriter, who is going to want to see a full year or two's worth of salary. So you got no history, no job history in that position, no home. So always remember, if you are going to change jobs, you really need to stay completely stable during that 30 or 40 days when you're in contract to buy that home. Just keep everything the same. That is the main key of this whole video, because I've seen it time and time again. Even though I talk to people, hey, don't do this, don't do that, it still happens, and it shocks me every time. It just happened recently, and it happened to somebody else I knew. It just amazes me. So I was like, well, I'm going to do a video on that. So moving on, this one should be obvious. What happens if you quit or get fired? Getting fired is never part of anybody's plan, but quitting voluntarily once you're under contract, it happens way more than you think. Maybe you hate your boss. Maybe you think you'll find the same job somewhere else, or you're just tired and need a break. But here's the harsh truth. 99% of the time, no job, no house. When you leave your job before closing, the lender has no choice. They will verify your employment the day before closing. So if they can't verify your employment that they based your pre-approval on, they can't fund your loan. So you've wasted all that time and energy, excitement, heartbreak, plus your inspection and appraisal costs. You're probably out $2,500 minimum at this point. So don't quit your job. If you really want to quit your job, wait until you get the keys in your hand. Debt to income ratios. I will explain the whole process of how debt to income ratios work. There's actually two, but we're going to keep it on the basic simple one. Your debt to income is the percentage of your monthly gross income that goes towards paying debt. For example, you make $5,000 a month and all of your debt payments, credit cards, car loans, student loans, and your future mortgage payment add up to $2,500 a month. Well, that is a 50% debt to income ratio. Now, lenders will look at two different ratios: all of your debt, not housing payment, and then the back end, which is the debt to income with the housing payment. Now, depending on your loan, that ratio needs to be under a certain amount. because those lenders have strict limits on that debt to income ratio. So picture this, you're right at that limit when you're pre-approved for a home loan. Then 2 weeks before closing, Saturday afternoon, you happen to go through a car lot and you're like, oh, let's buy a new truck. So you add $600 truck payment to your credit. That will put you over your debt to income if you are borderline. So now the lender has got to deny your loan application. Why? Because that Ford F-150 was more important than the house. So before you buy a new car, wait until you buy your house. Wait until you get the keys in your hand. That's the moral of this video. Wait for the keys in your hand. Now, I'm not saying go out and stretch out a whole bunch of debt after you buy a house and quit your job, but before you close on your house, these are the important things you really got to watch out for. Now, you've already got to this point. You've saved for a down payment. You've made your earnest money payment. You've gone through all the hard work to get to this point. Don't blow it now. And even after you close on that house, don't blow it. Don't go out and spend all your money, create new debt. You don't need to. You've got to that point. You've worked this hard. Don't do it. This one's kind of a hidden one. So you've got decent credit. You've got pretty good credit, but you have a family member that is trying to buy a car or also trying to buy a house or whatever, or renting an apartment. So they ask you to co-sign for them. Well, guess what? That's going to go onto your credit as well. And that could kill your debt to income. A lot of people don't understand that. I've seen this happen just a couple times, just because people are trying to help some family member out. They're in a bad spot, so they ask to co-sign, and you go ahead and co-sign for them on their car payment or whatever, on their new car, new rental house, whatever. That's gonna kill it. So don't do that. Now, something else to understand, most of the loan programs out there will allow you to have a gift payment for, say, your down payment or your closing costs, but that gift payment has to be accompanied by a signed gift letter from the giver stating that the money is a gift and not a loan. The underwriter needs proof that that came from the giver's account and documentation of the deposit into the account, into your account. What they don't want is a wad of cash deposited into your account or a Venmo account into your account. It's really important to document any large transaction money. So if you need to move money from one account to another, make sure it's all documented and where all that money came from and where all that money is going. You need to be able to document all of that throughout the escrow process. All right, so here are some pro tips that will keep the lender on your good side. First off, respond to all documented requests as soon as possible, like within the day. Same day responses are gold. Save every pay stub and bank statement. You're probably gonna need them anyway, and most of the time they're on your phone, but make sure you have access to them. Keep your spending minimal and stable. Treat your bank account like it was a museum. Don't touch it. Communicate everything with your lender. Over communicating is better than under communicating. Let them know what's going to happen or what you're planning, and they'll tell you don't do it or go ahead. And ask as many questions as you want. There's no such thing as a dumb question when you're buying a house. Look, this could be, and most likely will be, your largest purchase of your life until your next house. So ask all the questions that you have. And if you got any questions, feel free to download my first-time homebuyer guide, which is in the description below, or you can give me a call, text, email. All my contact info is in the description below. And with that, I hope you guys got a ton of information out of this, and hopefully it was helpful and you learned a little bit. And if you did, hit that subscribe button, and also check out these other first-time homebuyer videos right up there. All right, have a great day. Goodbye.